Hello, everyone, and welcome again to this weekly webinar produced by Business Performance USA. And we always love having guests on our webinars every week, and we're glad to have you here this week. We have Roz Davis Grimes back with us today. She'll be doing Budget Essentials, how to use capital expenditures. And as you know from tuning in to hear her in the past, she does an excellent job of keeping things simple and explaining the basics regarding budgeting. I'm Cynthia Stewart. I'm the managing partner with Evermore Services. I'm your partner in building tomorrow's businesses today. And Roz Davis Grimes is our executive presenter. She's president of Leadership Diagnostics. She holds an MBA and is truly an expert in financial operations, in financial analytics, and sought after for those skills. She's developed and delivered financial and systems training for national and global corporations, and I can guarantee you that you can tell that she's an expert at training on these things as well as the subject matter itself. She's particularly adept at building and managing processes necessary to ensure proper revenue. And she loves to do process improvement of those processes, and she's engaged very actively in various projects along those lines as we speak. She's helped companies realize millions in financial and accounting operations, including a large call center operation employing over 5,000 people that realized $60 million in savings. So if you need help in this arena, you need to find Roz Davis Grimes. You know, in order to make this time worthwhile for you, we want to encourage you to use this chat feature. Anytime you have a question, go ahead and type it in the chat feature. I'll be monitoring that, and at the best time, I'll let Roz know what your question is. Also, you might write this down. If you have a question about a specific situation at your workplace, write down Victor at businessperformanceusa.org, and Victor will call on any of the volunteer executive consultants to help answer those questions if he cannot himself. You may review previous webinars, BPUSA webinars, on YouTube, youtube.com, user bpusa.org. And now we're all ready with the introduction. And Roz, we'd love for you to get started. I'm going to go ahead and change the presenter over to you. And we'll look to see your screen come up.
All right, and make sure that you guys are able to see my screen.
Okay, we see it now.
Awesome. Well, welcome again to the Budget Essentials. Today we're going to be doing the basics of capital expenditures, and I'm very thrilled to be with you today. There's three things that we really want to cover today, and one of them would be common types of capital expenditures, an example of the capital budget models and tools that you can use to assess your capital expenditures. And then we're going to just briefly chat about how capital expenditures impact the operating statement. And since this is the basic of capital expenditures, how about we get started with the definition of a few basic terms. Okay, so when you think about capital expenditures, you want to think on the lines of long-term assets that can be depreciated. And we'll give some examples of those a little bit later on in the session. But you may say, I understand what long-term means, you know, it's referring to like an extended period of time, but what is an asset? I'm glad you asked. An asset can be described as anything that's owned of value that you can either exchange it, you can sell it, liquidate it, something that you can convert to cash, okay? And there's current assets, fixed assets, tangible assets, intangible assets. And right now, I want to kind of talk a little bit about intangible assets. Intangible assets, or they can be described as something that adds value or has value in the marketplace. And generally, according to GAAP, it can be amortized over 5 to 40 years in most cases. And in some cases, as it relates to technology, it can even be less, more like 3 or 4 years. And I've worked with a company that, a technology company, and we basically depreciated the life of that technology over 3 years. Also, when we talk about intangible assets, we may think of some things like copyrights, trademarks, maybe a patent, or in some cases, intellectual property. One thing to remember about intangible assets is that they're non-physical things. That means you can't hold it in your hand. You know, it's something that simply adds value or has value in the marketplace. One of the other things I think about when it comes to intangible assets, I think of things like name recognition. So many of you are probably familiar with like Michael Jordan or Tiger Woods. You know, they have worldwide name recognition, right? Michael Jordan, he's known for his, you know, fantastic basketball skills, 6-time NBA champion, 2 3-peats with the Chicago Bulls, right? And I remember when my son was in junior high school, you know, he had to have a pair of Air Jordans. And those things, let me tell you, they were very expensive for a junior high kid to pay over $100 for a pair of sneakers, right? And then as growing, you know, he had to have them in different colors, different sizes, the whole 9 yards. Well, why did he want Nike Air Jordans? Because of Michael Jordan, right? I want to be like Mike. Everybody wants to be like Mike. You know, and then he wanted to wear the Hanes, the boxers. You know, Michael Jordan was promoting that. So Michael Jordan had name recognition that he associated with a product. And think about Tiger Woods. Tiger Woods, he had about 74 wins on the PGA Tour, 14 professional major golf tournaments. And he did some Gillette commercials, Buick commercials, AT&T, Nike, Gatorade. So when you think about this, you can think that this asset, the name recognition, is not really physical, but just as tangible assets are something that you can hold, that you can see, that you know you can touch, and they can be damaged, the intangible assets can be damaged as well. And you know, we think about both Michael Jordan and Tiger Woods. They both reportedly had marital affairs. For some reason, when Michael Jordan did it, you know, it wasn't as big of a deal as when Tiger did it. Or even if you think about Lance Armstrong, you know, he won 6 or 7 Tour de France titles. You know, we're talking about name recognition. He was an inspirational cancer survivor. You know, he endorsed many major organizations, including Nike, but Nike dropped him. So just like tangible assets can be destroyed or damaged, intangible assets can be destroyed and damaged as well. So when we talk about long-term depreciating assets, it can be the purchase of that asset, or it could be the maintenance of that asset. For example, if you purchased equipment and the life of the equipment is done, but you can maintenance it to extend the life, and you're going to say you're going to put $100,000 into that, that also can be considered a depreciable asset. So we talked about, you know, intangible assets, and some of those that could be trademarks, registered trademark, copyrights, patents, things of that nature. And then we talked about the tangible assets, which could be property, equipment, So those are kind of the two different type of assets that we talked about. So I guess, Cynthia, now if we could kind of go to one of the polling questions, kind of want to see an idea of where we are with our group here. So the question that we want to ask you is about capital expenditures, how much you know about them. Do you think they have to do with future benefits, creating future benefits, fixed assets, operating expenses, or could it be both A and B, or is it all of the above? When you
Okay,
think about
folks.
capital
I'm sorry, Roz, go ahead.
I was gonna just kind of ask them, when you think about capital expenditures, what do you think about when you think about those things?
Okay, folks, go ahead and mark one answer on this poll, and then we will report the results. And we have about 25% of the audience voting. Go ahead and choose one. Oh, that's up to 75%. Let's go ahead, give another couple seconds. There we go, 100%. Okay, Roz, what we're finding is kind of a mixed bag. Um, People think about creating future benefits. We had about 10% talk about that. Fixed assets, we had about 20% on fixed assets. No one selected operating expenses, and we had about 40% select A and B, and then we had the remaining select all of the above. So, what's the right answer, Roz?
Okay. When we're dealing with capital expenditures, we're talking about creating future benefit. You're wanting to make an investment so that you can get a great return on your investment in the future. And there are exactly fixed assets that are considered capital expenditures, as we talked about a little bit earlier: property, equipment, things of that nature. So yes, it is A and B. However, it was a little trick question, Cynthia. You don't normally think about operating expenses when it comes to capital expenditures, but capital expenditures does have an impact on the financial statements, particularly the operating statement by way of depreciation. So we're going to talk a little bit about that as well. All right, and we've pretty much talked about some of the common capital expenditures. And what I want to do right now is I really want to kind of get engaged a little bit on capital budgeting tools, because I think there's an interest, a great interest in that. You know, what kind of tools do I use to assess them, and how can I tell if it's a good investment or a bad investment? So let's go to there. And one of the tools that you can use is the payback period. And when you think about the payback tool, it's just a real simple tool that says, hey, how long, if I invest this amount of money, will it take for me to get my money back? Very simple. So here we have a little chart here, and it basically says we're going to invest $2.5 million for some equipment. Let's just use that as an example. And as a result of purchasing this equipment, let's just assume it's going to reduce 2 full-time headcount. So we'll have a labor savings of about $250,000. And let's just say, based on the increase of productivity of this new equipment, it will increase our revenues, and the revenues will generate about $475,000 in additional cash flow for the year. Okay, so you probably asked me, why would I include the labor savings in this in recovery of the cash flow? Basically, if you're going to purchase this equipment, you will no longer be outlaying $250,000 of cash in labor expenses. So you want to consider that. So when we look at this, over the whole year, we're expecting $725,000 in cash flow as a result of purchasing this new equipment. So if we look at this over a 4-year period, we'll see it's just basic mathematics. You start out with the purchase, the cash outlay of $2.5 million, and each year we're expecting $725,000. So you do the math, and roughly when you come down to about year 4, it would take you about a little less than 3.5 years to actually pay that back. So it kind of gives you an idea of how long it takes to recover the money that you invest, and it's based on cash flows. One of the things about the payback model is that it does not take into consideration the time value of money, okay? Nor does it take into consideration the profitability based on the project of the life of the equipment or the life of the project that you're doing. So on this slide we see here, basically, we see that it would take us about, 3.5 years to pay it back. But if the life of the property or the equipment is going to continue to generate those similar cash flows, we can see at year 10, we basically have an additional $4.75 million of additional cash flowing in. So when you look at the payback model, you generally stop after where you see the debt will be paid. Okay? So that's one model that we like to use. Another poll question, Cynthia, and this is going to lead us into our next part. Would you rather have $100,000 now, or would you rather have $100,000 5 years later? Let's see what the poll answers.
Okay, we've launched the poll, so people can go ahead and enter their votes. This one may be a little bit easier for people. They're 75%. Not taking us any time for this one. Okay, we have 100%.
I bet it's unanimous.
You know what? People want their money now, Roz.
Absolutely. I don't blame you. Me too. Me too. When we look at the payback method, I'm just going to go back for a second. When we look at the payback tool, you're assuming that the value of your dollar today will be the same value that your dollar will be in the future. And really, that's not the case. Any idea? Can somebody fill in the chat window and share with us why that you think that would not be true? That the value of the dollar today is not the same value that it would be tomorrow? Use your chat window. Okay, the cost of money becomes more expensive over time. Artificially low interest rates by the Fed, okay. Exactly.
Yeah, and we had one more. Sorry, Roz,
okay.
one more. We had someone say inflation.
Absolutely. That's a good one. That's a really, really good one. Exactly. Because the money that you have in your hand today is generally going to be less in the future because of, like they said, future inflation. And not only that, the money that you have today could possibly be invested to grow as well. So another tool that we use is what we call the net present value. And the net present value, it kind of compares the value of money now with what it will look like in the future based on a discount rate, okay? So $1 today is going to be worth more than $1 in the future, all right? And when we look at the NPV model, it seems a little bit complicated, but again, it's just basic math, okay? When we look at this formula, we look at this over time. So let's take that same example that we had based on the $2.5 million purchase of the equipment and the cash flows of $725,000 per year. And it's just basically the mathematical formula of taking the cash flow divided by 1 plus the discount rate, and you raise it to the year, okay? And when you do that, we've done this on the chart here, and you can see how each year that same $725,000 is devalued, right? Or it's less than what the previous year would be, okay? So when we do this, and I would like to really show you this in the Excel format, since a lot of us work in Excel. Are you guys able to see my screen okay, Cynthia?
Yes, we are. Looks good.
In the Excel model?
Yes, we see the
Great.
Excel.
Okay, good. So basically, if we are assuming a discount rate in the Excel format, this is pretty much the formula that you would use to get the NPV for the year. So as you can see, we're taking each year up to the life of the equipment, okay? And there we have what our total would be based on the NPV of the 10 years. Now, I'm going to change this to 10% for a second, okay? So this is our NPV formula based on 10 years. And I'll just go into the Excel formula here in case you want to kind of see what that looks like. Up at the top here, you can see that formula. And here it gives us our MVP. Now there's another way in Excel to do this as well, if you like, and I know this is not an Excel class, but trust me, you'd really want to learn how to do this basically in Excel than calculating this out yourself. But there's an NPV formula in Excel that you can use as well, where it also takes the cash flows based on the number of years and the discount rate. So you can calculate that as well. And when we get to the NPV cash outlay, basically what we're looking at from the NPV cash outlay is we're taking the $2.5 million and we're going to subtract that from the NPV. That's going to get us our net cash outlay. And when we calculate our profitability index, that is what's going to determine whether or not this is a good investment. So the bottom line for the profitability index, if you want to look at that, it's basically the NPV divided by your original cash outlay of $2.5 million. And when we do that, we get the profitability index of 1.78. And what that's saying is, based on today's dollar, it's $1.78, or in present value, inflows, which is good. So basically, anytime your profitability index is greater than 1 in calculating your MVP, it is a good investment for you to make. All right. And And now what I'd like to do is I kind of like to talk about the IRR. And go back here for a second. Sorry. The IRR is short for internal rate of return. And basically, the IRR is a calculation to determine the discount rate where the net present value is equal to 0. Okay? And it's great to use if you have multiple projects competing for the same investment dollar, because basically you would want, of course, the greater MVP, and you'd also want the greater IRR of the projects to determine which investment will make you the most money in the shortest amount, right, of time as well, right? So you may want to look at the payback as well. So there's no one particular tool that just stands alone that you can look to say, okay, this is a great investment, especially when you're comparing multiple projects to see where you want to spend your investment dollars. And again, the higher the IRR compared to the discount rate to the MVP, the better. All right. So here, I just want to, again, kind of take you to the Excel model and talk about the IRR. So here, we're looking at pretty much the same information from the cash flows of the $2.5 million investment. And one thing that we have here in Excel, there is also a formula in Excel for the IRR that will allow you to determine what the IRR could be. A lot of times people kind of guess what it is, and you know, and one of the things I want to show you that has an impact on the IRR is the direction in which, if someone is guessing, that they would want to do. So if you're calculating it yourself and you're just guessing it, you know, if you look, we're going to change this. Let's just change this to 15% as the discount rate, okay? And the discount rate, if we change it to 15%, we're going to see our profitability index change. So our profitability index went down, right? So if we keep going up on the discount rate, we see our profitability index goes down. However, of course, consequently, if you decrease it, we had original discount rate of 10 that we were going to discount the value. On the other hand, we see the profitability index goes up, okay? So when you're guessing the IRR, you want your net present value or profitability index to be 0. So here, as we can see, we calculated it at 26%. So if we were to go 27%, our profitability index is less than 1. So we could continue to just keep guessing at it, but again, like I said, there's a formula in Excel, this IRR formula that's very precise, and you don't have to guess about it. So again, talking about the internal rate of return, the key is that when you're looking at multiple projects, that you want to determine which project to invest in. You want to look at the IRR to make sure that you have the highest IRR and the highest net present value as well. And again, you might want to look at the payback to see how long, if they're the same, which one will pay you back quicker. All right, another tool that we can use is the ROI, or the return on investment. And the return on investment is just a simple calculation. It's expressed as a percentage, and it's just the earnings minus the investment divided by the investment. So if we were looking at these two projects and we were looking at the ROI on these, we would want to select the one on the left, because basically it's saying, we're going to earn almost twice as much money as we invested. The return would be twice as much as we invested, versus the one on the right is basically saying we're losing half of what we invested.
We did have a question that came up.
Oh, sure.
Can my accountant help set a discount rate?
Yes, your accountant could help you set a discount rate. And if you're working with a financial planner, I would even recommend that you would seek your financial planner for a discount rate as well, because they're probably more in tune with the market. And the reason that you're looking at these different tools is because, one, you want to determine if the discount rate is greater than what you could receive if you invested that money, then you would want to invest into the capital expenditure. However, if let's say you can invest the money, like we were using 10% of the discount rate, but you could invest the same $2.5 million into a return that's going to give you a greater return than 10%, then you may not want to, invest in that capital expenditure. You might want to invest where you would get, say, 15% on your return, or 12%, or even 20% on that return. Good question. Good question. And so one of the things on using the capital budgeting tools, like I said, Excel is an excellent model that you can use to develop a model and have all your information in one spot so that we can see whether or not the numbers look right on that. And again, you want your profitability index to always be greater than 1, and you want your IRR to be greater than the discount rate. So here we see our discount rate is 27%. We're saying that our IRR should be at least 26. So we see that the 27% discount rate is greater than the 20%. And so that would not be a wise investment. Again, here we see the profitability index at 98 cents, which means you're going to be losing 2 cents on that investment overall. So let's go to 15%. Oops, not 15,000. Okay, so given this example with a discount rate of 15%, a profitability index of 1.46, and an IRR at 26.1 or 26.2, use your chat window to let me know if you think you would invest into purchasing the equipment. Great. I see a unanimous yes, 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 yes. Fantastic. Absolutely. You got it. You got it. Very good. Very good. All right. Briefly, within the next few minutes, I kind of just want to talk a little bit about, we have another polling question before we get to the next section. So, Cynthia, I'm going to turn it over to you for the next polling question.
I had to word the question a little bit different, but it means the same thing. Which two models would you select to assess $2.5 million purchase? So go ahead and mark A, B, C, or D. And we have kind of a mixed bag again here. Looks like
Okay.
everyone's voted and they don't all agree. So this will be
Okay.
interesting. We have it split. We have about 20% that say payback and NPV. We have about 25% that say NPV and IRR. We have about 15% that say C, NPV and ROI. And then we have the remaining say payback and return on investment.
Okay. All right. Right. So basically, for those that want to select the payback and the MPV, they're more or less interested in seeing how fast can I get my money back, and whether or not my profitability index is greater than 1. So, am I going to make more than $1 that I'm investing for $1, right? And then on the NPV and the IRR, those are probably more concerned regarding, what's my future dollar value in the present, right? And, could I invest this money somewhere else and make a greater return? Then for C, again, looking at what's my future dollar value looking like, and for the return on investment, how many times, or based on the investment that I'm getting, how many times more money am I going to make than my investment? Something similar to that. And then, of course, payback and ROI, it's all about the Benjamins, more on the cash side. Okay, how long is it going to take me to pay it back, and how much am I going to get based on my return? 1.5 times, 2.5 times, or something to that effect. Good. All right. So there's no real, like I said, standalone model, and it's really a good thing if you look at all 4 of them. I think all 4 of them, if you look at them, it can give you a broader range to help you make a better financial decision instead of using 1 or just 2. Roz would prefer to know, what's my future value going to look like, and is my discount rate greater than the rate of return, right? All right. And so, how does capital expenditures impact the operating statement? And basically, capital expenditures impact the operating statement based on depreciation of the capital investment. So when you look at the life of the capital expenditure, for example, we looked at a $2.5 million investment, right? And the life of that particular equipment was considered 10 years. So we would take the $2.5 million and divide it by 10 to determine what the annual depreciation would be for that piece of equipment. And of course, that would be amortized by month. We would take that again and divide it by 12. So each one of those amounts would depreciate, and it would hit the depreciation account on the operating statement. So it doesn't immediately have an impact. I know, for example, when I was working for one of the telecom companies, we would basically wait until the project was completed, signed off on, then we would actually begin to depreciate based on at the time that the project was signed off on. So, if you're looking at, for technology's sake, if you're looking at, spending over a year developing that technology, while you do have an impact on the cash flow, because you're definitely paying money out, you cannot depreciate that until after the project is complete. Okay, so you don't have the immediate impact where depreciation hits the operating statement. It's after the project is complete. Again, you take into consideration the investment, you take consideration the life of the property or the equipment or the technology or whatever, and you divide that basically by the life of the project, the life of the technology, equipment, or whatever, and then just an annual divided by 12. That would be what your depreciation is. So we also, well, I just got through explaining that. Capital expenditures impact operating statement based on depreciation expense, basically amortized over the life of the asset. Again, it is not an immediate impact. So, next to the last polling question, should depreciation be included as an expense item on the operating statement? And Cynthia, I'll turn it over to you for the poll to see what responses we get.
Okay, folks, go ahead and place your votes. Almost there. We have about 80% voting. Think about it real quick based on what Ross said. Yes or no? There we go, 100%.
Absolutely, yes. Depreciation should be included as an expense on the operating statement. And capital expenditures does not go on the operating statement. However, you will see the investment on the balance sheet. You will see the asset on the balance sheet, but not on the operating statement. Now, here's a good question. We didn't talk about this, so it really gave me a good chance to see the feel of the group today. Does depreciation affect cash flow? So, Cynthia, I'll turn it over to you for the poll.
All right, I've launched the poll. Select yes or no. And we have the votes coming in. Depreciation affect cash flow. Ross, we have about 75% that say yes and 25% that say no. What say you?
Okay. Depreciation does not affect cash flow in the sense that depreciation is an expense on the operating statement. It looks like, it is a debit, from the revenues. So it looks like it affects the cash flow. But basically, when you're talking about cash flow, again, we're dealing with cash inflow and cash outflow. Depreciation is more of an accounting term in the sense that it does not really affect cash. There's no cash coming in, there's no cash going out with depreciation. The cash effect was based on the capital expenditure, but not depreciation itself. So the answer to that is depreciation does not affect cash flow.
Ross, will you address the impact of taxes on the
All right.
how does depreciation affect what you have to pay out in taxes, which do affect cash flow?
Well, generally, on the earnings, they would add back in depreciation. So they would add depreciation back into the earnings or the bottom line
So they'd have to
because
pay.
there's no real cash effect on that.
Mm-hmm. Okay, very good. I'm glad you
So
addressed that.
the earnings would increase. We're talking about cash flow, or we're talking about the taxes on it,
Yeah,
on the
that's correct.
depreciation. Is that
That's
what you're
correct.
saying?
Yeah, is there an effect on
Yes.
cash flow as a result of depreciation? That's what we're talking about.
Okay. Is there an effect on cash flow regarding depreciation?
As with regard to taxes that you have to pay, does depreciation factor into the taxes you pay and therefore
Okay.
affect your cash flow?
Actually, depreciation is a benefit. Depreciation is a benefit to the taxes that you pay. I'm sorry, I misunderstood what you were asking. Yeah, basically, depreciation is a benefit to the tax. It's a tax advantage.
Okay, thanks, Ross.
Because it reduces the earnings. It reduces the earnings of which the tax would be affected. Yeah. Yeah, it would be a benefit. Okay, with this time, are there any other questions?
Yeah, folks, go ahead and put your questions in the chat box. We have a little bit of time now. We have about 10 minutes before the top of the hour, so we can take your questions. And we have one coming in. Does capital spent on assets always come from cash, or can it be borrowed or investors' cash?
Okay. Does it always come from cash?
So it
Um,
sounds like the cash flow of the company,
no,
or
it's
can,
not. It does not always have to come from cash. No, it does not always have to come from cash. Um, basically, investors, yes, you could get a loan on that to purchase it. Again, you would want to determine, if your interest rate, you want to look at your interest rate as well, right? And so that's some of the factors that you would probably also want to include in that when you're looking at some of these models. But it does not necessarily have to all come from personal cash or cash within the company. It could come from investors' cash by way of loan. Yeah. Good question.
so Ross,
Any
thinking
other
about
questions?
the model that you showed us, that assumed that the $2.5 million came from cash. So there was no additional accounting for the cost of money or the finance charge, what you had to pay to get a loan.
That's true, right. That's what I was saying. You also want to, for example, if you were borrowing that 2.5 million, you would definitely want to include any interest that would be on top of that as well, because that would be the full cost of the expenditure.
Looks like we have another question coming in. So how do you post return on capital, assuming capital is from within the organization?
how do you post return on capital, assuming that capital is from within the organization?
So in other words, your earnings, you went through and you showed us the earnings on your capital investment, the return on the capital investment. Is Do we have to account in any way for the return we get on that capital investment?
You know what? I'm going to have to do a little bit of research on that. So why don't you guys submit that to Victor at BP USA, Business Performance USA? Is that what it is,
Yeah,
Cynthia?
it's Business
Submit
Performance
that to Victor,
USA.
and I'll get back with you on that.
Yeah, and we'll show the website, I believe, on the last slide.
Okay.
Okay,
Okay.
so what about any equity given up in the business that that is sorry, transferred to investors for the capital they invested that's invested into the business? Let me read that again. What about any equity given up in the business that's transferred to investors for the capital they invested into the business?
Okay. The equity. Okay, you can't. You can. I don't believe that you can consider that as part of the capital expenditure. Is that the question that they're asking? Can they consider that as part as a capital expenditure and
Well,
use
in
that in the
equity,
modeling?
yeah, I guess what we need to do is sort of pull this apart. What about equity? Equity is really your shareholder value, right? The equity in the business. So this question almost presumes that you're giving up equity that is in the business. And it, it's
You
really
know what?
about paying off the
Have
capital.
them send that to Victor as well, because I want to be able to understand it, and I know it's kind of hard to put that in the chat box, but have them send that question to Victor at businessperformanceusa.org, because I want to give them an answer, but I want to get a little bit more information on what they're thinking with that question.
I think it has to do with the fact that if you go to the market to get your cash, let's say that you sell your shares and you've gone to the market to get extra cash by selling shares, then you're giving up a percent of ownership in the business. So
And
it's
how does that relate to the capital expenditure
yeah,
question?
if a company needs to really make a significant investment, let's say they need a new plant, new factory, a new plant, or they've got to move out of where they are, and so they're going to have to rebuild for some reason, and so they really are. Let's say they're strapped for cash. They're going to have to go. It's got to be a publicly held company or one that they can go to for investors like venture capital, that kind of thing. So they're
Right.
going to have to go to the market to get their cash to invest in the capital, and there's a transfer of ownership, therefore. So that's really what that question is regarding. It's about giving up equity in the business because you you went to the market and sought investors for the capital. So complicated question, probably a little more complicated than we're talking about in this particular webinar, but surely once we give Roz a chance to really take that, um, take that, kind of unwrap that question, she'll be able to answer it. So we will go ahead and move on to the closing slide now, Roz.
Okay, and I think, and if I'm if I'm kind of understanding it, I think that's more of a capital investment versus a capital expenditure question. So yeah, so I would like to have a little bit more conversation to better understand what they're really asking.
Okay, very good. Do we have a final slide, Roz?
Uh, see. Um,
Maybe that talks
well,
about what's coming up next. Oh, there it
here
is.
we go.
All right. Well, Roz, thank you so much for making things a lot clearer for us with regard to capital expenditures and showing us the various ways that we can consider if those are good expenditures or not. And this wraps up your Budget Essentials series. And you can look at those YouTubes to look for 5 easy steps to a better budget, budget within a budget, and also for today's webinar. And next week we have myself. Going to be talking about mighty results, delivering mighty results. And really, what we care about is, well, what got you here, get you there. Following that, we'll have every Tuesday, we'll have Victor, we'll have Jeff, and so forth. So join us on Tuesdays. Go out to our YouTube, businessperformanceusa.org, bpusa.org on YouTube, and you will find these webinars. We welcome you back next week, and thank you for attending today and for your attention, for your questions, and for your polling. Bye, everyone. Look for us next week. Same time, same place. Bye bye.